Hey guys, it's Justin Goodbread here with Financially Simple. I'm in the Financially Simple studios today, and I wanted to share a little bit of behind the scenes on some of the things I deal with day in, day out. Now, I can't get into too much detail, but I thought this was intriguing, so I wanted to shoot a quick live video on it. You know, we're in our series on shooting a couple of live videos for you guys on Facebook, and I received the question today. It said, Justin, should I pay cash for my house? It's like, well, that's interesting. You don't hear that every day. So here's this deal. Someone just sold a house, and they walked away with $400,000 after taxes, free and clear, and they want to buy a new house for $400,000. And all things being equal, it appears that they could pay cash and be done with it. And so the question was, Justin, should I pay cash for the house, or should we finance it? And we had to make some assumptions with this individual. We haven't even started the financing process. I know the bigger picture, so there's a lot more than just this one thing. You know, if you're asking questions like this, then hopefully you're 100% up to date with your certified financial planner, and they know exactly what's happening in your life. But this came down to a $380,000 decision. It was a big decision this individual was going to make. So let me show you, or let me walk you through the way we think as certified financial planners, knowing math. Again, this is not emotion, this is pure math. So if they were to finance a house, they would put 20% down on this house. They would put $80,000 of the $400,000 down. And they would turn around and mortgage roughly $320,000. So let's put those two numbers out there. The first thing we have to think about is a $400,000 house, and we were running this over a 20-year time frame. That was what the client wanted to look at. They said, Justin, if I paid $400,000 for this house, what would the house be worth in 20 years? So we took $400,000. We had made the assumption, client's numbers, I agree, this is a fair conservative assumption, that the house would appreciate at roughly 3% over the next 20 years. And if that were to be the case, then this $400,000 house in 20 years is going to be worth $722,000. Now remember, a house doesn't care if it has debt on it. That's one of those things that many people don't understand. Whether the house has debt or not, it's still going to appreciate the same price. So if it's worth $400,000, and if the assumption was 3% return, then the house would go from $400,000 to $722,000 over the next 20 years in this scenario. So that was the first one. They said, okay, we could put $400,000, pay the house off cash. The house would be worth $722,000 in 20 years. The next scenario was, well, what happens if we just took $80,000, put it down as our 20% payment, and then finance the house with a 20-year mortgage at a 4% interest rate? And so if we did that, the monthly payment would be about $1,950 a month, okay, for the mortgage. Now let's assume that we were going to take that other $320,000 and we were going to invest it. Just put it into an investment account. And that investment account would return, according to the client, they said, Justin, let's assume they would return 8%. I don't have an opinion on whether or not the market's going to return 8% on this type of podcast, or this type of a video. I don't know what the market's going to return. This was the client's number. I'm not promising it's going to return 8%. I'm not saying it's going to return 2%. For all I know, they could put $320,000 in the market and it could go to zero over the next 20 years. Now, it's never happened. It's never happened unless you made some really bad decisions on investments, but that's when you work with someone like me. Most of the time, the market, or historically, the market is going to do fairly well. Again, past performance is not indicative of future results. We all get that, right? But let's assume that they put $320,000 in an investment account and it made 8%. And let's be fun with this. Let's say we took and we paid the mortgage payment out of that investment account. So every month we took $1,940 out of the investment account every month to pay the mortgage. So that most people are concerned about, well, I don't want to pay a payment. Okay, let's let the investment account pay the payment. At the end of 20 years, the house is paid for. There's $722,000 in value in the house. We get that. And yes, we paid a ton of money in interest to the bank. I get that. But at the end of 20 years, by investing the $380,000, there is roughly $546 left in the account. That's pretty amazing when you figure out we put $380,000 in there. So we put $380,000 into the account. We grew it at 8% on this mathematical constant assumption, just an assumption, guys. And at the end of 20 years, there was $380,000. Now, the number could be greater. The number could be worse. It could be. So the question becomes is, should we pay off a house? Now, in this client's perspective, they said, no, I've got enough other monies at any given time. Should I need to pay a house off, I can. If that 4% interest rate gets to be too annoying or it gets to be a bother, I can pay it off. So guys, the biggest key I want you to take away with is just because you have debt on a house doesn't mean you're going to get any greater or worse value on appreciation of that asset. The house is going to appreciate the same with or without debt. That's what a certified financial planner is looking at. Now, we talked about all the emotion. We talked about the pros and the cons. We talked about debt. We talked about the philosophy that so many radio personalities talk about. We also dealt with taxes. We know the tax ramifications of dealing with this. We also dealt with the net worth. We know the risk in the net worth should we have estate issues that comes about. Should they have long-term care issues? We dealt with that. We dealt with should we get an attorney involved for trust type protection. This is what a certified financial planner can do. Hey, look, if you're not working with a certified financial planner, right now the Heritage Investors office is taking on 2 new clients here in the next couple of weeks. We have some room for that. If you're interested, holler at us. If you want to learn more about this, check out the blog, financiallysimple.com. We also have a podcast, Financially Simple, and we've got a YouTube channel. We're having a lot of fun pushing some stuff different places. This is what I do during the day and after hours. When I hear something that some of our clients or even people who call in with questions that are just like, wow, that's pretty cool, like this, I'm going to feel free to share them. If you have a particular question that you want answered, hey, drop me a message. Guys, like I say every day, life is hard, life is good, life is hard, life is good. Hey, look, money doesn't have to be. Let's continue to make our lives at least financially simple. Y'all go out and make it a great day.